Hi, Dave Roscoe here. If you watch videos regarding Pi or any crypto, you'll see them put up charts that depict graphs, candles, averages, patterns, and they'll give you all kinds of price predictions and use terms like bullish and bearish indicators. And they'll use this to talk about the future prices of crypto on the exchanges. Will it gain? Will it fall? By how much? What does it mean? This is called technical analysis. What they're doing is using data and applying several types of statistical analysis and historical comparisons to try to predict market sentiment and its impact on future pricing. In this video, I'll discuss the basics of technical trading, how it could be a trap which plays into the hands of exchanges and whales, and what it means for Pi. But first, let's go over some metrics from the last 24 hours. Starting with Pi Block Explorer, the current circulating supply is 6.76 billion. And once again, there has been no change to that number, meaning that there's no migrations that have happened in the last 24 hours. And in fact, over at least the last 5 days that I've been watching this. So migrations are still paused. There have been no new migrations. So if you're frustrated about that, join the crowd and you're still going to be waiting. Locked migrations are down 810.5 thousand, and unlocked migrations are up 810.5 thousand, meaning that once again, the only activity on the circulating supply is that 810,000 Pi have gone from locked to unlocked and are now available for trading on the exchanges or sitting in your wallet, whichever you choose. Looking at the price action, the current price for Pi is 82 cents, which is up 1.13% over the last 24 hours, with a volume of 234.33 million, which is down 45.38% over the same period. Market cap is at 5.59 billion, up 1.1% over the last 24 hours. So let's talk technical trading and how it could be a trap. Technical trading relies on common indicators such as the Relative Strength Index, or RSI, which measures trading momentum, how strong the market is moving in any given direction, positive or negative. The Moving Average Convergence Divergence metric, and that's used in various ways to determine momentum of pricing and trend following. Bollinger Bands are used to gauge volatility. Fibonacci retracement, everyone loves this one, and it's used to identify support and resistance levels. Now, if you don't know what those are, that's fine. I'm just going over with you some of the tools technical traders use. And Fibonacci retracement is particularly useful during price pullbacks and extensions to help set levels for gauging price movement within certain values. There are a lot of other tools that are used. I'm only touching upon a few that are very common. And there's also things like patterns that they look for. And these are combinations of trend lines, moving averages, and candle patterns. They have all kinds of different names, and they mean different things to technical traders. They have head and shoulder patterns, bull flags, triangles, many more. I won't go into them because there's a lot of them. But in this case, if you're interested, Google is your friend. Because all of these things are widely used, and it's well known how they're used, they can be self-fulfilling. For example, if everyone sees resistance at $1 based on these metrics, then traders will place sell orders there. Especially if you're taking advice from other technical traders, right? They're giving you advice, and if you agree with them, you'll follow it. And suddenly you create what they predict. So if they see resistance at $1, traders place sell orders at $1, and suddenly the price struggles at $1. No surprise here. If the RSI is oversold, many will expect a bounce. And this will cause buyers to step in. And guess what? The bounce happens. Again, self-fulfilling prophecy. But you know what? They're not the only ones who know this. Exchanges and market manipulators know this as well. For them, it's like a chess game. Market actors with more capital than you, a lot more, and better data with faster execution know where retail traders place their stop losses, and they know the triggers for creating buying and selling pressure. How do they know this? Because they read the same data you do, and they know how you're interpreting those patterns, and they can use that against you. They can do things like faking patterns. Because they have the ability to control pricing, they can create patterns that they want and then use that against you. The technical traders look for these patterns. They know how they'll be interpreted. Then they'll manipulate you. Whales and bots and exchanges can break levels that are indicated by these metrics. They know that technical traders are using these things to plan their trades. They can get those trades to shake out any way that favors them. And the technical traders, basically, they're left holding nothing except a lot of losses. These manipulators can cause volatility, leaving technical traders scrambling to stop their losses, attempt to recover their gains, and enter a spiral of destruction that has caused the full liquidity of many a naive trader. Their goal is to shake people out by creating stop hunts. Stop hunts are when prices dip below support levels to trigger stop losses. They will manipulate the price to cause those stop losses to kick in, forcing the price down so they can buy it up low and then ride the bounce and sell it higher. They can create bull traps, which are fake breakouts that lure in long traders. You'll see these patterns show up, and all of a sudden, the long orders in the books rise. It's fake. They know it's fake. It'll dump, and the price will drop. Everybody gets caught. They can create liquidity grabs. This is an interesting one where they have large positions that they need to sell at or buy at, depending on what they're doing. What they'll do is they'll manipulate the price by pushing orders into clusters at the prices that they need to satisfy their large positions. Now, you don't really need to understand all of this, and I certainly don't claim to be an expert. Like I said, I've done this a bit in the past, and it's just not for me. You want to learn technical trading, look on YouTube and Google and all that, and you'll find videos that explain it all, and they know all the information you're being told, and that can be used to control your behavior. This makes crypto trading very difficult to manage and prone to overall losses for most traders. It's all a rigged game. Now, what does this have to do with Pi? Well, quite a lot, actually, because Pi is now on the exchanges and you're playing in the same waters as these whales and sharks. Pi has low liquidity. Despite almost 2 billion coins in circulation, there's only about 400 million on the exchange, and that's not a lot. It's very easy to manipulate prices with such low liquidity. They'll use this to trick technical traders and scoop up large amounts of Pi for themselves. If you trade Pi on exchanges, the chances of you losing it all is very high. The very fact of Pi coin existence on exchanges allows manipulators to control pricing, even if you're not buying or selling. Look how the market reacts whenever there's a large unlock of Pi. The price typically goes down, at least in the short term. Whales and bots watch these things, and they use this to create price increases and drops. If large amounts are deposited or unlocked, it creates fear of a dump because these things can suddenly be put on the market with large sell orders. If large amounts are withdrawn, it creates a signal that supply is dropping and it causes the price to rise. I'm not going to give you advice, but keep in mind that the true value of pi is yet to be realized. There's no need for haste. So remember, the success of Pi Network begins with you. Pi to the moon. Peace.